Good morning. Thank you for taking the time to visit with me today. My name is Jason Nishaw. I'm one of the financial advisors here at Bogart Wealth. Today, we're going to be talking about the retirement planning timeline, one of our webinar Preparing for Retirement series. So before we get started, a little bit of background about Bogart Wealth. So we're a registered investment advisor. Our core competencies are financial planning, investment management, tax optimization, as well as tax preparation. We're managing about $1.7 billion of assets under advisement. We're advisors to about 900 households. 90% of our clients are major oil company retirees or current employees. We are fiduciaries, which means we are legally obligated to put our clients' interests before our own. We have no hidden agendas, no conflicts of interest there. If you look at our firm, we have about 23 folks on our wealth management and planning team, as you can see here. And then we also have a tax team. We have 4 members on our tax team with whom we coordinate for our tax planning preparation for our clients. We have 3 office locations. We're headquartered in McLean, Virginia, and then we have an office in Houston in the Memorial City area, and then one in the Woodlands as well. Our primary goal at Bogart Wealth and our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. We take a very holistic approach, foundationally starting with cash flow planning and retirement planning, and then building on that and looking at analysis of corporate benefits, whether it's pension versus a lump sum, net unrealized appreciation of stock in the 401k, supplemental plans. So we take a very comprehensive, holistic approach and look at multiple generations. A natural kind of follow-up or outlay from one of these webinars is to engage us in a one-on-one financial strategy session. A great opportunity to run the numbers, look at a financial plan. There's no cost, no obligation to do it. Gives us a great foundation to see if we're on track. And then if we need to make any course corrections or adjustments on the way, we'll be happy to help with that. So I strongly encourage you to reach out. We'd be happy to assist you in that regard. So today's talk is part of our retirement readiness series. We've been doing this for a couple of years. And have a number of different topics that we review. So I encourage you to go to the website and review some of our previous webinars talking about things like retirement income planning, Social Security planning, tax planning, estate planning, NUA, net unrealized appreciation, long-term care insurance, and then Roth versus traditional 401k IRA. And then last but not least, the mega backdoor Roth conversion. So, and also if you have any suggestions or things that you want to see, please feel free to reach out and let us know. We'd be happy to add it to our current webinars at a minimum, or if it warrants a whole new presentation, we'll be happy to do that as well. So happy to get feedback from our viewers there. So when we kind of break down the retirement planning timeline, we look at it from a number of different frames of reference. So more than a year out, and then when we're getting close within a year to retirement, and then once you actually reach retirement, and then going after retirement, post-retirement. So we're going to kind of break down into 4 different time frames of things that you should be looking out for when you get to each of these segments in time, in the timeline. So when we're more than 1 year out, very foundationally, we have to know the rules that guide the calculation of your pension, tax laws guiding the distribution of retirement assets, rules regarding your 401k. And additionally, we need to know what investment options that do you have as you're getting closer to retirement. So making sure you're optimizing and being as efficient as you can with your asset allocation. Also very important is know the information about your savings plan, know the investment options, know the limits, so you can maximize your savings in that regard. Additionally, we strongly recommend running the numbers in a financial plan. So having that ready to go. And that also gives you an opportunity to, talk to a couple of different advisors, get comfortable with one of them, see if you can build this trial relationship. So when you actually get to retirement, we have a lot of moving pieces in terms of 401k rollovers, pension lump sums. You have a relationship in place where you can hit the ground running. So great opportunity to kind of get that process started more than a year out before retirement. So in regards to pension rules, the most important piece of legislation that's dictating pension rules today is the Pension Protection Act of 2006. So this affected a big impact on a lot of ExxonMobil employees, as well as employees at other companies that had defined benefit programs. So what the Pension Protection Act did, first, it limited companies in offering a lump sum option. And then most importantly, it defined the discount rates that can be used for the calculation of the lump sum. And we'll kind of talk about those in more detail. And then additionally, it defined the actuarial tables that are used to establish life expectancy and to calculate the lump sum as well. So kind of standardize those inputs to the lump sum calculation. And then outside of kind of the pension specific rules, it allowed non-spousal beneficiaries to do rollovers. So if they inherited a qualified asset, they could roll it over. And then with regards to 401k plans, they actually allowed after-tax balances that somebody has in a 401k to be rolled over to a Roth IRA while still in service with the company. So this is going to be, this opened up the door for the mega backdoor Roth that we talk about further on in this presentation. Additionally, it allowed for company matches to the 401ks to be diversified outside of company stock. So some of our older ExxonMobil employees will remember that extra 1% match that they contributed, they had to be in Exxon stock. Prior to 2006, after 2006, they offered that extra 1%, but it could be diversified outside of the company stock. So opportunity for diversification there. And then additionally, the Pension Protection Act defined contribution limits to both IRAs and 401ks, which we'll expand on as well. Okay, so specifically for the ExxonMobil pension program, this Pension Protection Act kind of created two classes of folks. So the first are grandfathered under the old rules, meaning those were folks who were over the age of 50 at the end of 2007 and had more than 10 years of service before the end of the year, beginning of next year, January 1st, 2008. The new rules of the Pension Protection Act did not apply to them. So another way to think about that is if you were at least 55 and 15 years of service by end of December 2012, you had a different set of rules. So what were those rules? For the purposes of discounting to calculate the pension lump sum, Exxon uses 95% of the 30-year Treasury bond rates, and they round that number to the nearest 0.25%. And then they used a 2000 ExxonMobil mortality table to calculate life expectancy, which was static and did not change. So if you were over 50 at the end of 2007 and had that sufficient experience, you would be dictated by these older rules for calculating your pension lump sum. For those folks who were not grandfathered in, who were under the age of 50 as of the end of 2007, these new pension plan rules apply to them as dictated by the Pension Protection Act. So it adds a degree of complexity. So it created three segment rates. So a short-term, intermediate term, long-term for discounting. And all three of those rates are based on high quality corporate bond yields. So if you look historically, high quality corporate bonds have higher interest rates than do treasuries, right? With corporate bonds, you always have a risk of default. So with that credit risk, investors require a higher yield. So the interest rates are higher historically with corporate bonds compared to treasury bonds. So the higher the rate, that actually hurts the calculation of the lump sum. So kind of the Cliff Notes version, as interest rates go up, the pension lump sum goes down. So having corporate bond yields used to calculate the lump sum compared to treasuries actually hurt the calculation a little bit because those yields are higher. But thankfully, we've seen since March of 2020, with the big drop in interest rates, we saw close to historic lows first and second quarter of 2021. They started to trend back up in quarter three and quarter four and are kind of stabilizing a little bit. So that was one big change, was the segment rates that were used. And then secondly, the life expectancy, actuarial tables, mortality tables are going to be based on IRS published tables that are released by the IRS every year. And as life expectancy goes up, that helps the calculation of the lump sum, because a greater life expectancy means there's more annuity payments that are then discounted back to find the lump sum. So if the trend in life expectancy increases, then that actually helps the calculation of the lump sum if you choose to go that route. So again, this kind of first started for pension plan participants in 2013. So the folks who reached 55 after December 31st of 2012 were subject to these new rules. Okay, so the next component of the Pension Protection Act was dictating what 401k contribution rules, what the limits are. So if you look in 2021, for example, there was no change from 2020 to 2021. The maximum that can be put in if you're under the age of 50 is $19,500. And this limit applies to your pre-tax and your Roth 401k contribution. So those two together cannot exceed $19,500. And then if you're over the age of 50, then there's an additional $6,500 catch-up contribution that you can do for a total of $26,000 for 2021. On top of that, there's an additional limit in the total amount that can go into your 401k plan from all sources. So that includes your pre-tax, your Roth 401k contributions, employer contributions. So for example, the Exxon 7% match, which is being reinstated in October, and then after-tax contributions. All of those sources together total $58,000. And then plus the $6,500 catch up if you're over age 50. So we have clients tell us, well, you know, I max out my 401k contribution each year at $26,000. Well, that's technically not true because we're actually looking at the over 50 contribution max of 64.5. So we do have room for after-tax contributions that we can put in, and we'll talk about that in a few minutes. So for those folks who have discretionary income and are trying to save as efficiently, as effectively as possible, we want to be mindful of all the sources for all the limits for both pre-tax Roth and then total contributions into the 401k. Okay, so switching over to IRA contribution rules. So in 2021, the IRA contribution limit for both IRA and Roth is $6,000, and that's total. So you can't contribute $6,000 to a traditional IRA and then $6,000 to a Roth. The total for both sources is $6,000, and then there's an additional catch-up of $1,000 if you're over the age of 50. And then really briefly, for those who don't know the distinction between a traditional IRA and a Roth IRA, the traditional IRA, typically you make contributions on a pre-tax basis, so you get a deduction putting in. The growth inside that IRA is tax deferred, and then when it comes out, you pay ordinary income tax rates on those distributions. The Roth IRA, on the other hand, you do not get a tax deduction putting it in. You put it in on an after-tax basis, but all growth is tax-free when you pull it out, as long as you're over the age of 59 and a half, and the Roth IRA account has been in existence for at least 5 years. So if it meets that criteria, all growth coming out is tax-free. So you can imagine that we're very biased in getting as much into the Roth IRA as possible. However, there are strings associated with that. So flipping to the next slide. So again, we talked about the tax-free growth, the tax-free withdrawals if the account's been open for 5 years. One additional benefit for the Roth IRAs is they do not have required minimum distributions. So for or RMDs. So for those of you who are not familiar with RMDs, at the age of 72, the IRS requires that you start taking money out of your retirement accounts, your 401ks, your IRAs, so that they can start collecting tax revenue on that. So with Roth IRAs, the benefit is you can leave them in there. Under current law, there's no required distribution. If you want to pass them on to the beneficiaries, they can inherit those on a tax-free basis. So great saving strategy there. However, the rub is the IRS imposes income limits on the ability to make contributions to a Roth IRA. So if we wanted to make a direct Roth IRA contribution, if you're married filing jointly, your modified adjusted gross income, which is essentially adjusted gross income, has to be less than $208,000 in 2021. So that's 208,000 in order to make a direct Roth IRA contribution. If your income is above that, we cannot contribute directly to the Roth. So the only opportunity that we have to put money into the Roth is via a Roth conversion at that point. In most cases with Roth conversions, that creates a taxable event. So if you're taking pre-tax money from a Roth IRA and you're moving it over to pre-tax money from a traditional IRA or 401k and converting it over to a Roth, that creates a taxable event. You're going to have to pay ordinary income tax on that converted amount. So for our clients who have discretionary income in the later ends of their careers, tend to be in higher marginal tax rates than they will be when they go into retirement. So if you do a conversion with pre-tax money at this point, you're converting at a higher marginal tax rate, which is not a preferred strategy to do. So with that being said, there are a few strategies that we recommend to our clients to help get around this. The first of which is a backdoor Roth IRA contribution. So I'm sure you folks have heard that term floating around. That's not the official name for it, it's the informal name. But basically, this is a strategy to circumvent the income limits for putting money into a Roth IRA by utilizing this backdoor Roth IRA strategy. So basically how this works is if you cannot convert directly to a Roth IRA, you can make a non-deductible contribution to a traditional IRA. So the IRS does not place income limits on the ability to put that $6,000 or $7,000 into a traditional IRA. It just limits your ability to get a tax deduction. So if you're over that $208,000, you can make a non-deductible contribution to a traditional IRA, and that means these dollars are now after-tax dollars in the traditional IRA since it was a non-deductible contribution. The second step would then be to immediately convert those dollars over to a Roth IRA, which is the second step, the so-called backdoor deposit. Now, why does this not create a taxable event? Because you're doing a conversion with after-tax dollars. So this is a mechanism for getting money into the Roth IRA via a two-step process. Rather than contributing directly to the Roth IRA, it's the traditional IRA first. So this is definitely a valuable mechanism as you're getting closer to retirement to get money into a Roth IRA where it grows tax-free. The one caveat is the IRS has what's called a pro rata rule that complicates this transaction. So from that rule, you cannot have any pre-existing IRAs with pre-tax money in them before you do this backdoor Roth contribution. And I'll give you an example of this. So let's say you set up a traditional IRA a few years ago and you made a pre-tax contribution of $7,000 for easy numbers. So that means you have $7,000 of pre-tax money sitting in this traditional IRA. Now you're at a stage where you cannot make a pre-tax contribution. You're going to make a non-deductible contribution of $7,000, which you put into this IRA. So now you have $7,000 of pre-tax money and $7,000 of after-tax money in this IRA. And it doesn't matter if it's in the same IRA or two different IRA accounts. The IRS aggregates all your IRA balances of one. So it's irrelevant as to which account it's actually located in, as long as it's in a traditional IRA. So when you go to convert let's say $7,000 into the Roth IRA, the IRS says you have to take a pro rata distribution of the pre-tax and the after-tax dollars that are currently in your traditional IRA. So you cannot cherry pick the after-tax dollars. So what that translates to is when you do this conversion, $3,500 of that $7,000 conversion is going to be pre-tax, which means it's going to be taxable when you convert. So ideally, that kind of defeats the purpose of doing this backdoor Roth contribution because we don't want to create an additional taxable event for you. So importantly, we cannot have pre-tax balances in your traditional IRA if you are attempting to do this backdoor Roth strategy. So secondarily to this, another strategy for getting money into the Roth is what we refer to as the mega backdoor Roth strategy. So again, the concept is the same, but we're actually utilizing the 401k plan, the savings plan, in lieu of a traditional IRA. So for example, in the savings plan, you can make an after-tax contribution. So you don't get a deduction, you put in after-tax dollars in the traditional 401k, and then the Voya plan rules allow you to twice a year take that after-tax money, withdraw it, and roll it over to a Roth IRA. So again, another great strategy for if you have discretionary savings, let's make after-tax contributions, and you can do this from either payroll or making a special contribution of after-tax at the end of the year, so you can write a one-time check. As long as you're under the max contribution limits of 58,000 under 50, 64.5 over 50, you can make an after-tax contribution to fill that out, to max out your contribution and get money into this Roth IRA. So it's a mega backdoor strategy because we can do much more than $7,000 per year, depending on how much Exxon matches going forward. So the front door piece, the after-tax going in first, and then in the savings plan. And then the second piece is rolling it over from Voya in the case of Exxon, and then putting it into a Roth IRA. So great strategy, great opportunity to get more Roth savings if we're over that income contribution limit. Okay. So going on to the investment choices component of kind of timing for retirement, and again, focusing specifically on ExxonMobil, the investment options and plan there. So we're talking about the accumulation phase as we're getting closer to retirement. We want to make sure we know exactly what the investment options are, what they represent, so we can be saving as efficiently and effectively as possible. So you have the opportunity to purchase ExxonMobil stock directly, equity units, extended market units, international equity units, bond units, and then balance fund units, and then common assets. So the first, of course, ExxonMobil stock. Buying individual stock, of course, is higher risk. You're not diversified. And we saw that in March of 2020 with a big drop and the delay in recovery. But with the presence of the Exxon stock in the savings plan allows you to do that net unrealized appreciation, abbreviated as NUA. And again, we have a whole kind of designated webinar discussing NUA, so I encourage you to look at that. But the Cliff Notes version is that net unrealized appreciation, or NUA, is a strategy, a tax strategy to get Exxon stock out of the savings plan and provide it with preferential tax treatment to provide tax savings for you. So the concept behind this net unrealized appreciation can be illustrated with a good example. So let's say you have $500,000 of Exxon stock. So market value is $500,000. You bought it for $100,000. So that's your cost basis. So let's say in normal course of business and retirement, you sell the stock in the savings plan, take the cash out for living expenses. So when you take the cash out of the 401k, it's going to be taxed as ordinary income at ordinary income tax rates. If you had done an NUA transaction, what that entails is taking this $500,000 market value Exxon stock, rolling it out of the savings plan in kind. So you don't sell the stock, you roll it to a brokerage account. When you do that, you pay ordinary income tax only on the cost basis, that $100,000 of this Exxon stock. The remaining $400,000 of appreciation from 100 up to 500,000 market value is not taxed when you initiate this transaction, but when you actually sell the Exxon stock down the road at your discretion. And when you sell it, that appreciation is taxed at long-term capital gains rates, which is a preferential rate compared to ordinary income tax rate. So the embedded tax benefit is the difference between paying it as ordinary income and then paying it as long-term capital gains. So it's definitely a tax strategy that can work to your benefit if you have Exxon stock that is low cost basis inside of the savings plan. And really quickly, just to jump ahead to looking at your actual statement, to look at the lots of Exxon stock that you've purchased, to see if the net unrealized appreciation is an opportunity for you. You'll notice on the back of the statement, it actually, the good thing is that Voya monitors and tracks the cost basis of every share that you buy and records it so we can actually assess and quantify what the tax benefit would be if you choose to do net unrealized appreciation. And the lower cost basis stock is typically what benefits the most from that. So for example, in this case, this individual had lots of Exxon stock. They bought at $11 a share, $12 a share, so on and so forth. And this would be stock that would be a great opportunity for net unrealized appreciation there. And then going back, I jumped through the first couple pages of the statement. So let me jump back a little bit here. So again, looking through the statement, you can kind of see the breakdown of the, excuse me, I'm jumping around here. You can see the breakdown of your contributions via, either Exxon stock, employer stock here, the equities, the equity units, extended international bond units, which I'll kind of talk about in a little bit more detail in a minute. And then additionally, it also walks us through what our after-tax balance is. So I alluded to in the mega backdoor Roth strategy that we talked about a moment ago is taking after-tax dollars and rolling them over to the Roth IRA. Well, your pre-87, post-86 contributions here will show you what you've put in on an after-tax basis. So looking at this portion of the statement here, this tells us what you've put in as after-tax dollars, and then the actual after-tax source, if we go back one page, this after-tax source here actually includes the basis and the growth of the after-tax. So a very important point is the growth is tax deferred, it's not tax free, which is why we want to take, and doing the mega backdoor Roth, we want to get the after-tax dollars into the savings plan and then rolled over to a Roth IRA very quickly, so we don't have a lot of growth that occurs inside the savings plan because that growth is tax deferred and not tax free. So that's a little bit of breakdown of kind of looking at these different components in your savings plan statement. And again, if you have any questions, I certainly encourage you to reach out to schedule a meeting with our advisors. We'd be happy to walk you through the breakdown of your particular statement. Okay, so one of the things also in reading your statement to be mindful of at the age of 50 is you have to input for catch-up contributions if you want to max that out for over the course of the year. It's a common misconception that for clients who are contributing a certain percentage of either before tax or Roth, that it will automatically start to go to the catch-up if you're over the age of 50 once you've hit the 19.5, but you actually have to put in a specific dollar amount of catch-up contribution, and you can verify that with a line item that you'll see on your statement stating the catch-up contribution and the dollar amount, whereas the other sources are done on a percentage basis. The catch-up contribution is done on a dollar basis. So if you're getting close to 50, I definitely suggest you look at that and make sure you're contributing on a catch-up basis to make sure you are getting that 6,500 in over the course of the year into the savings plan. Okay, so now kind of going back to the the other investment options in the savings plan, we looked at and talked about some of the implications with the Exxon stock there. So kind of going into the equity units. So equity units is an index, a fund that just tracks the S&P 500 index, which we know are the largest companies in the US by market capitalization. So investing here is represents about 70 to 80% of all the publicly traded US companies. So these are going to be your Amazon, your Johnson & Johnson, Microsoft, et cetera. The big boys in the markets are going to be in the equity units. If we look at the extended market units, so this tracks the Wilshire 4500 index. So these are looking at mid and small cap companies, basically all publicly traded companies outside of the S&P 500. So if you want exposure to small and mid-sized companies that are still publicly traded, the extended market units will allow you to accomplish that. And then looking at the international units, this tracks the EFA index, which is an index of large and mid-cap companies in 21 developed countries outside of the US. So you can see the list here. One thing also important to note is Hong Kong is included here. So mainland Chinese companies that are listed in the Hong Kong Seng, they're in the stock index in Hong Kong, are going to be incorporated as part of this index. So currently it's over 900 companies, and it's about 85% of the market cap or capitalization in these countries. So this will give you developed market exposure outside of the US. Bond units. So this, the bond units approximates the Barclays US Aggregate Bond Index, which tracks an index of 17,000 bonds publicly traded in the US markets. It includes a mix of US government, so Treasury, corporate and mortgage-backed securities and mortgage bonds. The index excludes high yield bonds, municipal bonds, inflation index bonds, and then bonds denominated in non-US currency. So if you want exposure to high yield bonds, if you think that space is going to do relatively well, you cannot do it with the bond units. And you can kind of see the breakdown within the Barclays index and that the bond units tracks. As of earlier this year, I should say, about 43% of it is in Treasury bonds, 25% investment grade corporate bonds, and then mortgage-backed securities and some other sources as well. And then one thing that we always advise our Exxon clients when you're allocating in the savings plan is you want to take into account the value of your pension lump sum or annuity. Because again, while you're working, that pension lump sum is approximating a fixed income component of the portfolio. It's sensitive in moving to interest rates and has the same risk exposure as bonds do. So we prefer to see, and again, each individual's risk profile is going to be different, but when taking into account the presence of that lump sum or annuity in the overall allocation, that usually leads our clients to be more aggressive with leaning towards 100% equities in the savings plan and not investing in bond units in the savings plan. So I strongly encourage you, when you're looking at your allocation decision in the savings plan, take into account the value of the pension while you're making that decision. And then the balance fund. So this is kind of a all-in-one investment where it's a breakdown of the other investment units. So 35% equity units, 15% extended, 25% international, 25% bonds. Again, the same thing, taking into account the bond units there when you're looking at that. Okay, the common units. So this is kind of the short-term money market equivalent investment option inside the savings plan. So it targets a $1 net asset value. It's not FDIC insured, but it's invested in very short-term interest-bearing notes. So the safest investment option in the inside the savings plan. They have variable yields, and actually over the years, it's actually been doing be able to get better yields than money markets that we've seen publicly traded. So again, good investment option if you have some short term that you want to park in a cash equivalent. Common assets would be a good option there. Okay, so kind of in summary, looking at the contributions to your 401k IRAs, evaluating how much you can contribute, which investments to make if you're doing on an after-tax, before-tax basis. And then very importantly is that the tax paid or the after-tax balance that's in the savings plan, taking note of the fact that it grows on a tax-deferred basis, not tax-free. So you want to get that rolled over to the Roth IRA as part of that mega backdoor Roth to get the growth occurring in a tax-free vehicle. Okay. So we kind of talked about the savings plan, the options there. Switching gears over to the pension. This is a very good slide, even though it's from 2007, but it shows the formula very clear for calculating the basic single life annuity from the ExxonMobil pension plan. So looking here, it's 1.6% times years of service times average pensionable pay, and that gives you your single life. And then Exxon takes an offset for Social Security because they paid into Social Security system on your behalf with payroll contributions. So they take a little bit of an offset there, and that will give you your single life annuity. And then to calculate the lump sum, using those 3 segment rates and the calculations we discussed previously with the Pension Protection Act, we just discount the single life annuity over the life expectancy, and then boom, you get your lump sum. So again, knowing how the calculation works, what can you do to increase the calculation is increase years of service, and then increase salary. And then additionally, the decision of initiating before 60 it involves a little bit of an offset, which we'll talk about as well. But knowing these as you're kind of getting closer to retirement is very important to understanding how to maximize these benefits. Okay. So, the very important decision, of course, with the pension is taking the lump sum versus the annuity. With the annuity, again, you have the guaranteed payment for your life expectancy. The only criticism I can really give to the ExxonMobil annuity is that we don't have a cost of living adjustment. So that's perfectly fine if you have other assets that you're going to be able to invest and grow to keep up with inflation to kind of minimize the worry about the cost of living adjustments, but it is not going to have an adjustment for you and your survivors' life expectancy. And then additionally, one downside is the principal amount goes to zero when you and your survivor pass away. So there's no residual benefit for descendants or heirs if that's something that you would like to accomplish. So again, assessing that is very important to do. Now, looking at the options for the savings plan going into retirement, we have a couple different options. So one is keeping everything in the savings plan as is. Rolling it out to an IRA, doing a lump sum distribution, part of which is going to go to an IRA, and then part of which, if you have Exxon stock, is going to allow you to do this net unrealized appreciation. And this is the only distribution option that will allow you to do the NUA transaction. Excuse me. And then a third option is you can actually go, purchase a private annuity with the assets in the savings plan if you so choose there as well. So these are the different options. What's more common with, again, folks who have low cost basis Exxon stock is to do the lump sum distribution. So when we kind of break that down a little bit further, what are the options there is we, of course, can take everything out as cash, pay tax on that, which again is in almost all cases is not the tax savvy strategy to do, but it is certainly within your rights to take everything out at one point in time. But what we typically recommend is taking the Exxon stock out in kind, so not liquidating it, particularly when Exxon stock is kind of in the 55 range. Right now, we've got some room to the upside. So we take the stock in kind, do not sell it. The shares that we decide to apply the NUA transaction to will roll over to a brokerage account. And then the shares that are higher cost basis, which we are not utilizing for net unrealized appreciation, will roll over to an IRA. And then the other sources, so your equity units, your extended international bond, common assets, those will get rolled over as cash to an IRA where they can be then reinvested. And here's another illustration of kind of the typical rollover from the savings plan. So again, kind of categorizing as Exxon shares that we're going to apply the net unrealized appreciation to. We'll go into a after-tax brokerage account, could be a joint individual or trust account. The Exxon shares that we do not apply NUA to will still stay in a qualified retirement vehicle in an IRA. And then the other investment units, common assets, cash will go to an IRA that is managed invested. And then if you have Roth or after-tax source in the savings plan, that can be rolled out separately to a Roth IRA as well. So this is just a graphic to kind of illustrate the common lump sum distributions from the savings plan. Okay, so kind of talking about the pros and cons of the rollovers, right? Now, rollover is very common when you're coming out of the savings plan with Voya. Again, the biggest driver, in my opinion, is the greater investment choices that you have when you roll over to an IRA. So it essentially opens up the whole universe for you. So you can not only, you can certainly replicate the investment options in the savings plan in an IRA by buying index-based funds, but then you can also expand your reach to, if you want to do real estate investment trusts, bonds, high yield bonds, alternative investments. Additionally, if you have Exxon stock and we want to diversify, we can employ covered calls, selling those, which basically a covered call option, for those of you who are not familiar with that concept, you're giving somebody the right to buy the stock from you at a particular price. And in return, you collect a premium for giving them that right. So you get to collect a little bit of a premium income, enhance your income, and then you can also set a price that you're comfortable selling the stock at. So this strategy is not available in the savings plan. And then additionally, we have more flexibilities. We can do limit orders to set exit prices and do good till cancel orders. So we can set a price that we want to get rid of a particular position, or purchase a position, we have flexibility in the IRA that we don't in the savings plan. So that, in my opinion, is the biggest driver. Additionally, the IRA allows for professional management, so professional money managers, advisors who can assist you with allocations. They can do so in IRAs outside of the savings plan. Reduces the stress for our clients who want to enjoy retirement and not worry about monitoring the markets all the time. And then on the bond side, again, it opens up the ability to purchase high yield bonds that have better yields. And we can also purchase individual bonds. So with individual bonds, you can lock in your interest yield and maturity with the flexibility you don't have in the savings plan. And then you also have more withdrawal opportunities. The VOIA and the savings plan, they restrict how many withdrawals you can do per year, whereas in IRA, you can access your money at any point in time. So in terms of the frequency of rollovers, so again, last year's 200 billion. So if you kind of look at that on a daily and hourly basis, it's a very common transaction, very frequent. Most clients roll out from the 401k in retirement because of those increased flexibility reasons. So once we're kind of looking at these pieces moving, the next logical step is determining what we need for our income in retirement and then what sources we have. So again, breaking down with Social Security, savings, pension, annuity, and if you decide to work part-time in retirement as well, assessing those sources, and then more importantly, the tax implications for pulling from those different sources. So the kind of big sources, Social Security, and again, we have a whole webinar devoted to Social Security discussing that. So I encourage you to look at that. But Social Security was never designed to replace a significant portion of retirees' income. For the very low income earners, it can replace up to 90% of income, but for the typical kind of U.S. median household, it replaces about 40%. And then for oil and gas industry employees, that number drops to more in the 10 to 30% range, depending on salary grade. So again, it's a portion. By no means was it designed to replace any significant portion of your retirement income. And then the pension, if we do the fixed annuity, again, depending on years of service and final compensation, it can replace as little as 12% or up to 70% of earnings. And again, we looked at the calculation to see what factors influence that. So number of years you've worked and then average pay minus the offset. So again, for kind of the typical ExxonMobil career employee, going to 60, it's going to replace about 50% of your retirement income. So again, looking at these two sources, Social Security, pension, we're looking at 60 to 70%. So again, we're going to have to bridge the gap from our savings and investment choices. So again, that's going to be the 401ks, IRAs, thrift savings plan, et cetera, to kind of fill that gap. So managing that withdrawal strategy and looking at risks like drawdown risk, longevity risk is very important to kind of assess. Okay. So again, looking at these pieces, complementing those again is increasing short-term liquidity. So for clients who are retired, we typically advise building the cash reserves higher than what we normally would have pre-retirement, because again, we want to increase that liquidity. Bond ladders, and again, that strategy in the current interest rate environment is not as attractive, because again, your yields are so low that you're getting negligible amounts on your bonds. So that strategy is probably a little bit more appropriate for a higher interest rate environment. But then other income producing investments. So if we're looking at dividend paying stocks, looking for higher dividend yields to produce income. And then also, as I mentioned, the covered call options, getting some option premium. So enhancing income with those premiums as well is something kind of to incorporate as part of cash flow planning strategies. Okay, so once we've kind of established what our cash flow sources are, it's very important that we establish what are the tax implications from drawing on those sources. So where the tax planning comes in, very important component. So again, understanding what are the tax consequences of a particular cash flow source is very important to help coordinate the whole drawdown strategy. So for example, Social Security, A portion of that is going to be taxable as ordinary income. For all intents and purposes, most retirees in your positions are going to be 85% of that is going to be taxable. So the majority of it's going to be taxable as ordinary income. If you're taking your pension income, that's going to be ordinary as well. Interest produced from bonds is going to be taxable as ordinary income. And then distributions from traditional IRAs, 401ks, pre-tax distributions are going to be ordinary income. And then if we look at more preferential tax treatment, so qualified dividends are going to be taxed at long-term capital gains rates. And then if we realize long-term capital gains, of course, those are going to be taxed at preferential long-term capital gains rates as well. And then as we discussed, drawing from Roth IRAs, provided it's over 59 and a half in your age and had the account for 5 years, the growth is not taxable at all. And then if we have assets that we're liquidating the principal, dipping in the principal when we sell it, of course, return of principal is not subject to taxation. So kind of knowing the framework of the different tax treatment allows us to optimize these decisions. So those things that you should be looking out for, assets that generate ordinary income should be housed in qualified accounts, i.e. IRA, 401k accounts that are taxed as ordinary income when they're distributed. So for example, if we have bonds that produce ordinary income in the form of interest, we want to have that in a vehicle that's going to be taxed as ordinary income anyway, to be as efficient as possible. And then assets that are producing income or gains at preferential long-term capital gains rates, so dividends, long-term capital gains, we want to house those more in non-qualified accounts to pay lower, more preferential rates in a taxable account. So again, managing the distributions from these different account types, depending on cash flow needs and tax laws, is very important. Particularly if we look at this point about reducing future tax bills. So required minimum distributions, which kick in at age 72 from IRAs, 401ks, the IRS mandates that you have to start taking distributions from your retirement accounts because they want to collect tax revenue on this ordinary income that's coming out. So again, we don't have a case where you don't touch your retirement accounts. We have these huge buildup in our 401k and IRAs. And then we have large required distributions. So we want to spread that out and manage that over time as we get closer to 72. So very important as part of the cash flow planning strategy. And again, very important is looking at this from a lifetime perspective. So that's where the cash flow plans come in and are so important is, a lot of folks will kind of focus literally on just one particular year, but we want to look at the lifetime of expected tax obligations. We want to minimize that. So if it involves Roth conversions, paying a little bit more tax now to save more down the road, it's definitely a strategy worth looking at. So as I mentioned, under current tax law, the breakdown of ordinary income tax rates starting at 10% and then working to 12, 22, all the way up to 37%. And then the capital gains tax rates for long-term and qualified dividends is at 0%, 15%, 18.8%, and then 23.8%. The most important takeaway from this is at every level of income, the capital gains tax rate is less than the ordinary income tax rate. So under current law. So it's always preferred to pay at these rates as opposed to these rates. Now, the Biden administration is proposing for high income earners. Again, the number is currently at $1 million of income. We've heard proposals as low as 400,000 of income, but they're proposing for high income earners, increasing the long-term capital gains to be equal to ordinary income tax rates. So there is a risk factor that's on the horizon. Everything is still in committee and discussion, but we may see for higher income folks that preferential difference is going to narrow and go away if those proposals get passed, get legislated. Okay, another thing we have to be mindful of is if we retire prior to age 59 and a half, because again, that's kind of the golden age where if you have IRAs, so for example, the pension lump sum, you roll that out, you can take the money distributions from those accounts at 59 and a half without penalty. So if we retire at 55, for example, we need to make sure we can bridge our cash flow from 55 to 59 and a half. So where can we pull from? If we have after-tax savings, we can pull from there. If we've pulled Exxon stock out of the savings plan as part of a net unrealized appreciation NUA, that stock is now in a non-qualified account. You can sell and take dividends to free up cash as needed there. Again, another source, if you decide to work part-time, do some consulting. If you can also take money from the 401k prior to age 59 and a half. So there's what's called a post 55 rule. So the IRS states that if you retire from Exxon or your company after reaching the age of 55, you can take distributions from that company's 401k prior to 59 and a half without penalty. So again, that does give us a little flexibility. If we have the savings plan, we can pull from that. And then additionally, there's a provision in the tax code referred to as a 72T distribution, which basically means you can actually set up essentially a private annuity coming from an IRA and take a set of standardized distributions over a 5-year window, subject to an IRS formula calculation. And this will eliminate that 10% penalty. So you do have an option. If you do need to pull money from an IRA, there is an exception to the penalty with the 72T provision. And then lastly, we can always do a line of credit, home equity loan, et cetera. Again, I'm not a huge fan of adding on debt, but if we can borrow at 2% and the money you have invested can earn 6 to 7%, then you're clearly making money. But again, we have to weigh risk tolerance with adding on debt going into retirement. Okay, so bottom line, all of these things are very complicated, very important. We can't emphasize enough having that plan going in a year plus into retirement to make sure you're as prepared as possible. And again, looking at all of these holistic factors to consider, as part of that comprehensive plan. Okay. Another thing that we haven't really kind of addressed, kind of going into that one-year retirement, is assessing spending. So again, spending is clearly important with the effects of compounding in time. If you look at your initial withdrawal rates, and again, with a conservative investment return of 5%, you can see the impact on your asset base is if you have a 5% withdrawal rate, for example, it takes less than 30 years to completely deplete your portfolio base. So again, the rate of spending relative to the size of the portfolio and the projected growth rate of the portfolio is very important to wrap your arms around as well as we get to that point. Okay, so again, when you're looking at potentially doing a financial plan with an advisor, very important to do the analysis on all of these components: annuity, lump sum, NUA, looking at the portfolio, asset allocation, the Roth piece, insurance, long-term care. All of these should be incorporated as part of your financial plan, making sure they're working together to maximize your lifetime expected benefit. Okay, so when you're looking at talking to advisors, very important, as I mentioned, Bogart Wealth is a fiduciary. You want to make sure the person you're talking to is a fiduciary, a transparent fee structure. You do not want a broker who is incentivized to collect commission and sell you commissionable product. You want to have someone who has a transparent fee structure and not incentivized to sell you additional services or items, products you may not need. Additionally, you want to see someone who's a financial planner, is comfortable with your specific company's retirement benefits, knows retirement rules, long-term experience, has a track record of managing portfolios. So we manage portfolios in-house. You have full visibility in the portfolio manager. We do not outsource to some third party or somebody you don't see, and then is open to discussing all these different strategies, reassessing, revisiting the plan, tracking your progress, performance versus the plan, and then also is very translatable, very accessible. So things to look at when you're looking at that advisor, kind of getting a year out. And then again, as we're getting closer to retirement, looking at some of these other webinars, the retirement income planning, NUA, very valuable tools to help you in that regard there. Okay, so when we're kind of in that under year time frame, again, looking at refining, determining your cash flow needs, income needs, talking with advisors, looking at trial accounts to build and establish that relationship, establishing the cash flow plan, confirming if we're under 59.5 versus over, and we have to do some of those mitigating strategies. Looking at the investment allocation, risk tolerance, watching and tracking the discount rate, knowing the year-end leave rule. So basically at Exxon, if your last date is, if your employee is the last day of the year, you get that 6 weeks of extra vacation pay in lieu. So very important there. And then kind of looking and evaluating your work situation if you have projects coming up, et cetera. Okay, so as we get to kind of 120 days out for Exxon folks going to retirement, so 3 important dates: the last date of payroll, first date of retirement, and then benefit commencement date. So Benefit commencement date is a very important date because that is the date that affects the discount rate if you do the pension lump sum. So the benefit commencement date can only be on the first of a month. So for example, if you retired December 31st, your benefit commencement date would be on January 1. And since January, it will fall into Q1 of the next year, the discount rates for that quarter are going to be the discount rates that are going to calculate your pension lump sum. So it's very important knowing when the benefits commencement date is, making sure it falls in the quarter in which you've selected based on what the published discount rates are going to be. So very important to kind of watch those dates there. And then, requesting the intent to retire package from benefits, informing your supervisor of these key dates, recording it with your Tiger timekeeper. And then if you're getting pay in lieu, you're not vacationing out, you have a form to do that. And then once you get the intent to retire package, making sure you review that with a second set of eyes with an advisor, and then of course the wrap up retirement party, turning in your laptop, etc., then transitioning to your personal communication and personal devices there. So with the intent to retire package, it's primarily related to calculating the pension benefit. It does have your health benefit information, but it cannot be used to change your health benefits. So in this, what we call ITR package, selecting the lump sum versus annuity. If you select the annuity, selecting the type with the various survivorship options, and then the tax withholding. And then if you do the lump sum, you have to select the custodian, the IRA custodian to which the lump sum is going to be rolled over. And then again, as I mentioned, having the advisor get a second set of eyes on it, very important. And then there are going to be areas where it need to be notarized as well. And then if you have supplemental benefits, SPP or additional payments plan, you will have additional notarization areas as well. And if it's not returned prior to 35 days prior to benefit commencement date, the pension benefit will be delayed, the payout will be delayed. However, that will not impact your ability to lock in a particular set of segment rates or discount rates as long as your benefit commencement date falls on that date of your choosing, regardless of whether you submitted it 35 days or less. Okay, so if we retire prior to age 60, when would we consider delaying the pension? So again, each year you get a 5% discount off of your single life annuity if you initiate the pension earlier. So if you have the ability to delay, then it reduces that haircut, so to speak, closer to 60. So that's one factor that you should consider. But another factor is what the trend in interest rates is. Again, it's very difficult to project out 2 or 3 years, but if you're close to historical lows like we are now, and we see the trend going up, that's typically the case. We want to lock in those interest rates, and that benefit of the lower interest rate now outweigh the detriment of taking that 5% haircut from the age 60 pension. So those are factors that we want to analyze and assess before you take the pension. And then when we actually get to retirement, right, getting ready to roll the savings plan over at retirement, again, make sure you do not take any withdrawals or conversions prior to the rollover. That will impact the ability to do net unrealized appreciation. And then, I'm very big on making sure you have the strategy, so leaving the savings plan in place at Voya, don't automatically just take it out for the sake of taking it out. Make sure we have the strategy for net unrealized appreciation, any tax issues, any estate planning issues, making sure we have the investment plan in place for when you roll the savings plan out. So assessing all of those factors before you actually initiate the rollover, which is a call with Voya. So again, the mechanics of actually rolling it over. So Voya will first have to benefit that you actually are eligible to roll it out. So the benefit commencement date has to have been communicated. If there's any qualified domestic relations order or quadro in the event of divorce or separation, any hold has been released there. And then you have to have read a special tax notice to verify that you're comfortable with all the different options with regards to withdrawals, potential tax implications to do it. And so with Voya, again, very important that we advise having the advisor on the line because of the degree of complexity. You have to specify if you are doing net unrealized appreciation, how many shares, which shares, how do you dispose of the remaining shares, how do you make out the check for the other assets, the equity units extended, et cetera. So very important to kind of have a second set of eyes and ears on you with that call as you do that rollover. Okay. So again, in addition to kind of looking at those pieces, of all the choices to be made in retirement in terms of Medicare supplement plans, initiation of Social Security start dates, distributions from retirement accounts, tax planning, portfolio planning, looking at the pension, a lot of different choices, very important to consult with an advisor. And again, I want to emphasize we offer one-on-one consultations. We'll look at your data, no obligation, no consultation, and we're happy to help out in that regard there. So thank you very much for your attending, and I appreciate your time. Have a good day.